my age and older, I think it's just, seeing an asset do what it's done over the last 12 years like this is it's kind of, this can't be reality. But look, I think last year or earlier this year with the ETF approvals and BlackRock and Fidelity and other big institutional managers getting involved, I think you really see how, the government and the regulators have come to embrace the technology and the need and the desire to have this asset be acceptable. I mean, the largest growing demand source for US Treasuries right now on a percentage growth basis, stablecoins. Right? I mean, stablecoins now are approximately $120 billion of demand for treasuries. Right? I think stablecoins are about $170 billion market cap, and about 70% of that is directly invested in T-bills. And so as the Bitcoin market continues to grow, the $1.9 trillion market, 120 billion or 170 billion of that is of stable coins. You kind of have a 7 to 8% ratio. If Bitcoin doubles again, that's another 120, 140 billion dollars of demand that's going into US Treasuries coming from stablecoins.
Hello, everybody, and welcome to My Two Sats. My name is CJK, and today I'm here with Craig Shapiro, macro strategist for the Bear Trap Report. I first had the pleasure of meeting him at the Naples Symposium, and he's what you would call a gigabrain. So I am very excited to have this conversation here today with him. Craig, thanks for joining me.
Anytime. Thanks for having me. Appreciate it.
So the big thing that's going on now, obviously, Trump landslide getting in. And I'm not sure politics has ever been so financial. How do you feel about the outcome of Trump, and how do you think that's going to affect, or is already starting to affect, the financial markets?
Yeah, look, I mean, this was a polarizing election. The from the market's point of view, the winners and losers between a Trump administration and a Harris administration were diametrically opposed, right? We had, definitely, whether it's crypto or domestic infrastructure or, there's other sectors that would benefit from a Trump administration, or, on the Harris administration could have benefited, like solar or cannabis or other sectors, right? We had real winners, real losers. And so the market, kind of up until about a week before, was, really undecided. And it seemed as though it would go down to the wire. But look, I mean, over the course of the kind of subsequent, few day period leading up to it, markets really started to move in a direction of a Trump win, as some of the polling data and some of the financial market, speculation data was pricing in an increased chance of him winning. And then as the days leading up to the election took place, there was an increased probability of a Republican sweep. And so I think that's what the market had been trading kind of going into the event. And look, a Trump administration with a Republican House and a Republican Senate allows him to do, much more than if it was divided government. And so what we've seen subsequent to that is a real aggressive pricing of Trump trades. And what we know is, Trump really is a tariff lover, right? I think he was even quoted on the campaign as saying tariffs is his favorite word. So
now, hold on, because
I think
you have some really good tweets on tariffs that I want to get into. So before we break that down for the viewers, let's backstep for an instance, and let's just give, for my audience, a general introduction. But what I always like to do, what's tradition on my show, is we have to hear your orange pill story as well.
Sure. So my background, I've been trading financial markets now for a little over 20 years. Predominantly on the buy side at various hedge funds, Osprey Capital and Point72 Asset Management, and a few others. And I had my own firm as well, trading in equities, commodities, FX, and rates. And so I've been doing this for quite some time at a variety of different shops. And then over the course of the last couple of years, I've just kind of transitioned to trading on my own family office capital, and writing and providing content and consulting to some family offices and to the investment public at large. And so more recently, I've taken on a role as a macro strategist with a firm called the Bear Traps Report. And we provide a research platform, trying to democratize the conversations that Wall Street is having. And so we have hundreds of clients around the world where we are aggregating a variety of topics and information from, like I said, various countries and various types of investors, and trying to understand what Wall Street is thinking and talking about, and then disseminate that information back out. So we feel like we're at the intersection between the buy side and the sell side, and trying to give that information back, because we're trying to identify where money is flowing and who's doing what and why. And so our contacts in the industry and actively trading these markets, I think, really allows us to help. And so we run a Bloomberg chat, and we are in the process of launching a Discord channel to provide that kind of information to the more retail-oriented community. So as far as Bitcoin is concerned, I mean, I've been, I found myself kind of dabbling into Bitcoin late 2016, early 2017, and I'd be lying if I said I wasn't dabbling into some of the other shit coins as well at that time. And so I think, like most of us, you kind of go through, the educational process, and you learn more about Bitcoin and these other things, and then, through the drawdown of 2018 and 19, getting wiped out on all the other garbage, kind of felt like really needed to hone in and understand and learn more about it. And so as we transitioned into 2020 and COVID, the reaction of the central banks and the government on money printing, both from the Federal Reserve for in their quantitative easing and purchasing of securities, but also Treasury just handing out money. Whether it was PPP loans or direct stimulus checks. I mean, you really understood that the government was going to, seek to print its way out of this demand shock that was coming out of COVID. And so I had previously, been more of a gold over Bitcoin person, but kind of really found myself transitioning to understanding, how Bitcoin being, the hardest money with a fixed supply cap, with kind of uncorruptible ledger, and really an environment where you cannot, the price of Bitcoin does not impact the supply algorithm. And so it's a completely unique asset. And so really, plowed into it then, and kind of been, averaging in kind of daily, really ever since. And so, look, I think where things stand right now for Bitcoin, I mean, finally moving into an environment where, the regulatory regime has gone from completely, complete animosity towards acceptance and in favor. And so it's kind of a unique environment for Bitcoiners, and look at, I think, probably the larger crypto community, although I don't dabble in any of those stuff anymore. Kind of Bitcoin only from here.
So would you say that a lot of people that from the traditional side of finance and have done what you've done, they struggle to understand Bitcoin? Like, it's hard to put a finger on it, but is it really like that mechanism where we have absolute digital scarcity, right? Like, regardless of what price goes to, you cannot expand supply. And is that like the brick wall that a lot of these analysts hit?
Yeah, I think the brick wall is use case in a lot of ways. Like, what does it do? It doesn't. It's you can't use it for anything, right? It's just it's store electricity, but no one makes payments really with it, and I can't really buy anything with it, and it's it doesn't exist. And what if the internet goes down? And a lot of these are this FUD has been debunked time and time again, but there's a reluctance, and I'm not aging myself too much. I'm 45 years old, but I mean, I think that for folks who are my age and older, I think it's just seeing an asset do what it's done over the last 12 years like this it's kind of and largely having missed it, for most people, they're like, this can't be reality. And really, if I want to store a value asset, I could just buy gold. Gold's been around for 5,000 years. And look, gold's done incredibly well, certainly lately, the last week notwithstanding, but just from a store of value, and as global central banks are shifting away from owning and holding U.S. Treasuries, given the deficit and debt situation in the U.S., many investors feel very comfortable kind of shifting allocations of bonds into gold, whereas crypto and Bitcoin has just been a harder bite. But look, I think last year or earlier this year, with the ETF approvals and BlackRock and Fidelity and other big institutional managers getting involved, I think you really see how the government and the regulators have come to embrace the technology and the need and the desire to have this asset be acceptable. And now with the with the Bitcoin community being as politically active as it was throughout this election season, I mean, clearly having a Bitcoiner in the White House and an administration that is supportive, I think is going to be tremendous. And the other thing I'd say, something that some folks have been talking about a little bit more, is just from a use case perspective. I mean, the largest growing demand source for U.S. Treasuries right now on a percentage growth basis, stablecoins, right? I mean, stablecoins now are approximately $120 billion dollars of demand for Treasuries. Right? I think stablecoins are about $170 billion market cap, and about 70% of that is directly invested in T-bills. And so as the Bitcoin market continues to grow, so Bitcoin now is, well, I don't know where we close to 89,000. So we're a $1.9 trillion market, 120 billion or 170 billion of that is of stable coins. You kind of have a 7 to 8% ratio. If Bitcoin doubles again, that's another 120, 140 billion dollars of demand that's going into U.S. Treasuries coming from the stablecoin community. So I think there's a growing acceptance that as Bitcoin grows and stablecoins grow, folks who are trading in and out of Bitcoin and have to store it there, want to move out, they'll hold their money in stablecoins, and then stablecoin demand for T-bills, that's a use case, right? So yeah, we're not there yet on payments, right? I mean, we're in the early stages, but that'll come over time. But from a store value perspective, being uncorruptible, having a dedicated and known supply algorithm from here for the next 116 years. But yeah, to your point, I think this idea that the higher the price goes, it has no impact on supply growth, right? Every other commodity, and I looked at all commodities, supply responds to price. So as prices can move higher, companies, invest capital to expand their production, and high prices, basically solve high prices. In Bitcoin, that's not the case because high prices do nothing to the supply algorithm. And so it's a truly unique asset from that regard. And with a market cap of 1.9 or $2 trillion or so, gold's a 16, 17 trillion dollar market. I think we flipped silver earlier this week, but real estate's several $100 trillion market. Sovereign bonds is a couple $100 trillion market, right? There is room to continue to see a shift in market cap from these other store of value assets into Bitcoin. And now with an accepting political environment in the U.S.,
it's amazing.
I think things look good.
The growth of this, it's and you mentioned stable coins. A lot of my listeners know because I tell the Byron Donald story of when I was at Bitcoin Energy Summit with him. But they're talking about stable coins as a solution for creating demand on T-bills, as you astutely pointed out, in the Financial Services Committee of the United States of America. So it's worked its way up to the highest political levels, Bitcoin as well. And we started out talking about Trump. And I find what's interesting was we tapped on use case. I wonder if Trump, if he gets in and in the first 100 days, hopefully gets this Bitcoin strategic reserve set up, if that's going to help make that use case better understood.
It's hard to know, right? I mean, well, currently one thing they could do is the U.S. government does already own Bitcoin, right? It has confiscated Bitcoins from a variety of illegitimate actors. And so my understanding, not an expert, we've been selling a lot of that Bitcoin, over the course of the last couple of weeks. We could just stop doing that. That would be a good start to kind of create a strategic reserve. Look, I think as far as, is the government going to actively be buying Bitcoin? Hard to know, because right now the government is running a couple $1 trillion deficit. So where's the money going to come from in order to buy the Bitcoin? Is the U.S. government going to run the Sailor playbook and borrow money at long duration rates and then take those proceeds and buy Bitcoin? I mean, they should. That's what Sailor does. But so I don't know, how much momentum a strategic reserve would have. But like I said, at minimum, stop selling what we already have.
Right.
Would be a good start. But look, I think I think Senator Loomis is going to introduce that kind of legislation, and there's plenty of talk about Scott Bessent being the Treasury Secretary, and he's a Bitcoin friendly and crypto friendly investor. And so I think, look, when you're running the government with a couple $1 trillion of deficits, and when you have $35 trillion in debt, and a bond market that is starting to slide, and foreigners who are decreasing their demand for U.S. Treasuries, the government and the powers that be need to figure out solutions, right? Need to figure out a way to reduce deficits, to reduce the debt to GDP ratio, and to run a more sustainable and growth-oriented economy that works for all Americans. And so I think there are solutions that incorporate Bitcoin into that, and I'm hopeful that that'll be part of it. But it's hard to bet too much on that reserve. But I think it should be considered as part of potential part of the solution to what they're trying to achieve.
Absolutely. I mean, we're working on that directly here at People's Reserve with our Bitcoin bonds, which is a principal protected note, depending upon who the issuer is. But if the U.S. federal government were able to take advantage of the structuring, then basically they would use the performance of Bitcoin to create demand for their debt. And I think that's like the missing piece here, because I'd like to get your feedback on this exact specific statement, which is, I believe the United States Treasury has lost the ability to create demand from smart lenders seeking a real positive yield by raising interest rates. How do you feel about that statement?
Yeah, I think if you go through some of the presentation, like, so every quarter the Treasury Department issues what's known as its quarterly refunding announcement, and that is a report that comes out from Treasury that looks at the supply issuance that they expect for the next 3 months, with an outlook beyond that, and whether or not they're going to be issuing T-bills or coupons of a variety of duration. Now, they are advised by what's known as the Treasury Borrowing Advisory Committee, TBAC, and that committee is made up of Wall Street firms, hedge funds, and a bunch of other market makers. And so what winds up happening every quarter is they run they do some special reports about Treasury demand, Treasury supply, different special topics, and what they just had another meeting 12 days ago or so. It was the Wednesday before the election, and Treasury really addressed this in a presentation. It talked about the decline in demand from foreign central banks for U.S. Treasuries for a variety of reasons, not the least of which is our sanctions policy. Right? I mean, the sanctioning of Russian reserves has created a backdrop where foreign central banks and foreign governments are more reluctant to invest and hold their excess reserves in treasuries, because they may at some point find themselves to be enemies of the United States. I think every country, probably save the United Kingdom since 1945, has been classified an enemy of the U.S. at some point. So it's not surprising that we're going to see a decline from foreign central banks for U.S. Treasuries. And so hedge funds have taken up the mantle in a large way. The third, fourth, and fifth biggest holders of treasuries now, I believe, are the Cayman Islands, Luxembourg, and the UK. Cayman, Luxembourg, clearly tax havens that are hedge fund oriented. The UK is a massively, double negative deficit country. So it's not clear why the UK is buying treasuries, unless you think, well, there's plenty of hedge funds in the UK. So that, I think, hedge fund demand has been taking up the mantle. And so, but look, hedge funds are a fickle source of demand. And so as Treasury, in order to kind of incent that demand, we need higher yields. And so Treasury is acknowledging this. And that's why in this most recent report, they talked about stablecoins, right? They talked about the need for this new demand source, right? If you think back to the mid 1970s, with the petrodollar system being created, we created demand for treasuries by kind of guaranteeing security and safety to Saudi Arabia if they recycle petrodollar excess savings into treasuries. But as we've declined that, as that's declined over time, the Treasury is looking for a new demand source, and stablecoins kind of fits the bill. But look, to your point, I mean, the government needs higher and higher yields in order to incent that demand for its paper if we're going to continue to run multi-trillion-dollar deficits. And so look, there was a report that came out. I forget the name of the organization, but it was like the Council for Responsible Budget or something that looked at both the Harris and Trump plans, the next 10 years. And even the Trump plan was looking like, it looks like it's going to add, I think it was like another $7 trillion to the deficit over the course of the next
baby. Burr.
10 years. And so, yeah, look, if you're going to do tax cuts, and you don't find spending offsets, it's going to be hard. So the market is looking for higher yields in order to tolerate that level of deficit spending and debt growth. And so Treasury needs new demand sources. This is, stable coins are one place, but it's gonna take more, right? We're gonna need, at some point, the Fed is likely to be forced back into buying of treasuries again. Banks are going to be regulated further into holding more treasuries on their balance sheet. They've already been and will be forced to do more with SLR reform and other types of things that won't count capital if they invest in treasuries. So more of that financial repression on banks and from the Fed is coming. But for foreigners and for private investors, I just, investing in a 10-year U.S. Treasury at 4.3%, just when inflation is running certainly north of 2, likely north of 4. Depends on what kind of data you want to trust in the government. You're just not being compensated appropriately for that level of inflation. And as plenty of people like to point out, long-term sovereign bonds are certificates of confiscation on a real basis. So you need to find other ways to protect your wealth in this inflationary environment. Bitcoin, gold, hard assets are a likely place that I think more capital is going to flock to.
Absolutely. I mean, if you're a business, I mean, I've talked to businesses who had 10-year plans, and they made these plans in 2020. And of course, right after they knew a truck was coming just a few months after that January. But you're looking to 2030 and you say, hey, if we store this value in a 10-year note, we should be able to build 2 full factories in 2030. And now they're looking at the pace of price growth versus yield, and they're saying, at this rate, if this continues, we'll be lucky if we can even build 1 factory in 2030. So you get forced to look elsewhere to store value. And it just so happens to be at that point in time where gold is I think, countries are figuring this out. Small businesses are figuring this out. Countries already know this. A lot of those trade surpluses, I think, finding their way back into gold instead of into U.S. Treasury debt. And then the really smart lenders, the ones who aren't regulated into forced lending, are saying, wait a second, if they bump these rates up, like back up to 5, say on the 10-year, I mean, they'll push the bill rate up, and then that will allow the rest of the yield curve to adjust. And maybe it wouldn't even normalize, right? It didn't normalize, which is weird because you would think, hey, rates are going up, they're saying higher for longer. Why are people buying those? It's only in anticipation of coming back down. Maybe it's a trade instead of an investment. And the banks are forced to do it anyway. But if that rate goes up to 5 or 6 or 7%, the higher that rate goes, the higher the interest starts to build. And that's been a no. We don't care about interest payments. Who cares? Janet Yellen said one time, well, it's so small, who cares? Now it's the number 2 item. And if rates have to go up to where they need to go in order for people to be at a neutral rate where they just gain or lose no purchasing power, that might actually force inflation in itself, because if you can't source the demand, then the Fed's going to have to add it to their balance sheet anyway. And where do you see all of this going? Because I'm with you. I don't think there's a way that this deficit turns into a surplus. Even if you get Elon and Ron Paul in there to clean up and eliminate waste, we're still going to have a deficit, in my opinion, because of the mandatory spending. But what does that mean? And especially if interest rates are going higher, what can we do to avoid basically the collapse of demand on the most important form of collateral in the system right now?
Yeah. Look, I mean, the Fed. I would imagine when the Fed cut 50 basis points in September, I imagine they did not think that event, not that the event specifically triggered a sell-off in the long end of the bond market on its own, but I think if they were to look back, they would have said, when we cut 50 basis points, we expect kind of the whole curve to shift down in yield. They wouldn't have expected, mortgage rates to move higher, right? They were cutting rates because they're trying to slow down the rate of labor market demand deceleration, maybe assist the housing market. And so what's happened is the exact opposite from what they would have thought. And so what we've seen is a curve steepener, right? The front end yields have moved down from 5.25% to 5.5% down to 4.5% to 4.75%. But the long end is moved back up again. And so look, I think the Treasury continues to finance itself in the bill market, right, at an increasing pace. It's not looking to increase the supply of long duration issuance because it is concerned that if they try to sell significantly more bonds than bills, the market would have an adverse reaction. If you go back to their decision, I mentioned this quarterly refunding announcement back in July of last year, when Treasury decided, okay, it's time to start terming out some of the bill issuance that was created post the debt ceiling alleviation. They decided to raise coupon issuance by $200 billion. The bond market flipped out, right? I mean, had a very violent reaction in long end bonds, and interest rates moved up 75 or close to 100 basis points between August 1st and the middle of October. And so the bond market does not like to see that increase in supply. But look, the more a country finances itself in the front end, the more like an emerging market it starts to look. And when you're starting to finance yourself with 3 and 6 month paper and 1 year paper, as opposed to 10 and 20 and 30-year paper, the creditworthiness is starting to become an issue. Your ability to control inflation starts to become an issue. And so I think Treasury is trying to figure this out. But what I suspect is going to happen is the Fed is going to keep cutting interest rates to lower interest costs on bills, and that means we're likely to be more in an inflationary environment, which is going to prevent them from being able to finance long duration securities in an easy way. And so I anticipate we're going to have a further curve steepener. I can imagine an environment where the front end is anchored at 3.5% to 4%, and we have 150 to 200 basis points of premium coming from the yield curve. And so, 10 years is 5.5%, 6%, 30 years are similar. And so, as long as the government continues to finance itself in bills, interest expense can go down, kind of the net of all that. But they'll have a more difficult time financing themselves out 10 and 20 and 30 years. And to the extent that the long end yields move materially higher, we could find ourselves in a situation where the Fed is forced to end QT early, which is very much now on the table for sometime early next year, even though reserves are still quite ample and there's no strain in the financing markets, right? It's just the Fed's number one goal is to assure Treasury market stability. They can talk all they want about maximum employment and controlling inflation, but really they are about controlling the bond market and making sure you don't have bond market accident. So to the extent that long end yields moved up too aggressively or too rapidly, we probably would find ourselves in a situation where the Fed comes in and caps yields at the long end of the curve at some point. I don't think we're there yet, but last October when we got up above 5%, it kind of freaked the Fed and the Treasury out of it, and so they changed course. I imagine if we got into a similar situation now, they would try to do something similar.
Yeah, it's wild because everything you just said, I'm thinking in my head, I'm like, this is like soft yield curve control. People think like everything's fine, nothing's really going on. No, they have to be super strategic, for the risk-free, pristine collateral of the system, to have to be so strategic with where you issue, when you issue, how you issue, and what amounts you issue. That's worrying to me. That's concerning to me, because if you were the dollar and you were risk-free, you could issue whatever the heck you want and raise whatever you want at any time, because the lack of demand would be overpowering. It wouldn't be lacking. So I just, something doesn't sit right with me in the Treasury market. I don't think it
Yeah.
is as risk free as people say it is. Now, you sent out a tweet recently. Let me see if I could pull this up here. Here is Craig's Twitter, guys. You guys check him out. Follow him if you're not following him. Great alpha coming out of it all the time. And let me go to my bookmarks here. Okay, so you said it right here. Strong dollar tariff wrecking ball on Trump tariff trade momentum is causing big problems for energy importing regions like Japan and Europe. So far, they have been fortunate that energy price momentum in oil and gas has stayed rather muted in recent weeks. But should we get some cold weather or another rise in geopolitical tension, things in Europe and Japan are going to go from bad to worse rather quickly. And I think that kind of ties together with this other tweet too, where you say financial markets are trading like the rest of the world, has no ability to defend itself against the Trump tariff regime that is coming to despite the fact that the US has massively negative net international investment position with close to 70% of GDP. There will come a point when foreigners start to sell their US asset holdings to bring money back home. Until then, stick with the US outperformance trades, but keep your head on a swivel. First place we would probably see this would be in foreign UST selling. So I think there's a lot going on with the tariffs, and we were going to go into that, but I stopped you because I knew we
Yeah.
were going to go into it later. I'd love to get your take on what's going on with the tariffs, and maybe I can throw an extra quick question in there too. If the dollar is getting stronger, um, that doesn't necessarily mean you can lower interest rates, does it?
Yeah, there's a lot to unpack there. But I think the thing we know about Trump, again, just to kind of hark back to the earlier discussion point, is this guy loves tariffs, right? I mean, literally, his favorite word, I mean, "Make America Great Again" is about America first and kind of prioritizing America's strategic interests and reshoring and American workers and bringing capital and jobs back to America. That is his plan, and he wants to use tariffs as a way to do that. And so this is, tariffs kind of get a bad rap, I think, by neoliberal and economists as kind of being antithetical to global development. But tariffs have been used in America for hundreds of years. I mean, how else did we become the kind of leading global superpower, post World War One and World War II, is through protecting our domestic industry. And so I think Trump recognizes that tariffs are a way for him to realign these interests and to, like bring production and bring jobs back to America. And so the point now is he's going to be aggressive on suggesting big tariffs. And so some of these announcements from his cabinet, whether it's Marco Rubio or Waltz for the NSA, and Lighthizer for trade, these guys are China hawks. We know China tariffs are coming in a large way. We don't know exactly how big they will be, but we know this is going to be front and center to the Trump agenda. Similarly, for Europe or for Japan or for whoever is trading with the US. I mean, Trump is going to threaten tariffs as a way to force countries to weaken their currency, invest domestically in the US, or stimulate their own domestic consumption as opposed to buying US assets. And so the market now is trading with that in mind. And that's why the dollar has been such a strong performing asset over the course of the last week since the election. Because if you're Europe or if you're Japan or if you're China or whoever and trading with the US, you're going to be generally fine with your currency now depreciating in anticipation of these trade negotiations with Trump. Because if you can have your currency depreciate some now, 5%, 10%, whatever the number is to try to offset potential tariffs, once you make that deal, maybe you go back to where we were right before the election. So my sense is the market is going to trade in that direction between now and January and probably into most of the first quarter. Currencies will adjust to the anticipation of this tariff regime until trade talks start to happen, right? And so I think that's the direction of travel now for countries and regions like Japan and Europe that are significant energy importers. Their weaker currencies create domestic inflationary pressures, particularly if energy costs move higher. And so, so far, oil prices have been relatively tame since the election, and even prior to that. I mean, there seems to be excess supply. OPEC has kept barrels off the market, but if we get a resurgence in Israel-Iran tensions and attack on Iran infrastructure, and oil has a $5, $10, $15 move, that's going to be a big problem for these energy importing regions. Similarly, on natural gas, Europe and Japan are huge net importers. Right now storage levels are generally running better than on average versus seasonal expectations, but nat gas is a weather bet, and if it gets really cold in Germany and in Italy in the next 6 to 8 weeks, you could start to see a big pull for LNG and for other sources of natural gas into Europe. That could lead to a price acceleration. Japan also is a big LNG importer. Korea is a big LNG importer. So, if we got big moves in natural gas, again, that'd be importing domestic inflation for Japan and for Europe. So what are they going to do? How do they slow down that inflation? Well, these countries all own significant U.S. dollar assets, right? I think there's the 16 or 17 trillion dollars of foreign ownership of treasuries, U.S. stocks, other U.S. assets that could be sold in the event that these countries felt like their currencies were getting too weak too quickly, or their inflation, imported inflation was accelerating too rapidly. And so my point was, while the markets are suggesting currently that Trump and the U.S. is just going to run over everybody else and it's going to be America first, America only, this is not like the 1980s when we had the run up into the Plaza Accord, where the U.S. was in a modestly positive net international investment position and debt to GDP was 30-40%. We're currently have a massively negative net international investment position, which means foreigners can retaliate by selling our assets. We have a massive debt and deficit situation, which means it's harder to finance the government if they're selling their assets and our interest rates are rising. So I anticipate that the economic war games that are accelerating now because of Trump getting put back into play are only going to continue to accelerate between now and the end of the year and into the first quarter next year. And there has been some discussion about a potential larger grand bargain, the Mar-a-Lago Accord, which has been being floated around as something that may or may happen early next year, where countries kind of get together and think about some sort of new currency regime similar to what we had in 1985 with the Plaza Accord. Too early to tell. Can't really trade on that, but something we got to think about, because a tariff regime and a tit for tat back and forth, we tariff you, you tariff us back, is very destructive for global growth, horrible for demand, horrible for the economies of the world, and likely, eventually, while being inflationary first, would then probably be deflationary. It would be a disaster, and we may end up there, but hopefully, Trump really is using these as a negotiating tool, and we'll find a way towards a sounder, smarter currency regime globally. But right now, I think it's dollar up, yields up, and if oil and gas start to move up, then kind of watch out. We could be in a risk-off scenario rather quickly.
Yeah, well said. And you mentioned oil and energy, and Trump is really big on that liquid gold, and he wants to open it up and increase supply. And maybe he's factoring that into his mindset, if he is even being advised of the consequences of these maneuvers. But what do you think? Do you think that if Trump were able to unleash, or I guess increase the supply of oil and that gas, and kind of relieve some of that price pressure that could be there, help it deflate down, that would potentially offset some of the deficit that we know we're going to get from his administration?
Look, I think it's one of the three arrows of the Besant plan is to try to increase oil production, by 3 million barrels a day, through deregulation and kind of being more friendly to the domestic oil and gas industry. I mean, I think there's some credence to that view. I think it is a little bit of a harder sell when you're trying to look. I think that Trump's a lower oil guy, right? He wants oil prices down. He wants gasoline down. So trying to tell the U.S. domestic energy industry to ramp up production um, to in the face of him wanting lower oil prices, I think there's some potential inconsistencies in there, so it might be difficult to incent them. I mean, shale production, new wells need kind of $55, $60 oil in order to come online. So to the extent that oil prices fall below that level, it's gonna be hard to get that production growth. So, but look, if he could somehow maybe bring down taxes or incent domestic production in other ways, maybe by putting up barriers for imported energy, then yeah, sure, I think he'll be able, might be able to help keep that down, keep inflation down, keep energy inflation down, and grow real GDP. And that's kind of their plan. They want to grow real GDP by 3%. They want to increase domestic energy by 3 million barrels a day, and they want to take the deficit down to 3% of GDP by 2028. Those are the 3 arrows of the 3-3-3 plan. We're currently running deficits of 7%. So to get from 7% to 3% is going to take, heroicism to say the least. I mean, the biggest buckets of spending, as you mentioned, are entitlements, defense, and interest. So interest, we talked about that. I mean, maybe that could start to come down if the Fed cuts rates and then they control the long end, and it's likely to lead the dollar higher. Lower, and it'll be more inflationary. But maybe they could bring that down a little bit. Defense, I don't know. I mean, are we going to be cutting defense spending in this world? I think we should be cutting defense spending for a variety of reasons, but I don't get the sense that is a bucket that they're ready to tap. Can Elon go in there with the red pen and clean up some stuff? Maybe, but the deep state and global military industry, probably is going to push back against that. So that's going to be difficult. And then on entitlements, I mean, that's been the third rail. I mean, it's hard to run, the 2026 congressional campaign with vote for us, we cut your Social Security, or vote for us, we cut your health care, right? I mean, so, and if we don't cut those 3 items, then the other stuff is just not big enough to move the needle 400 basis points to get from 7% to 3% of GDP deficits. Now, tariffs could help, right? If we start bringing in a couple $100 million a year more in tariffs, that would help. So I think there's some ability to kind of move on the deficits, but I don't believe there's a big enough red pen out there to actually get to that level of deficit reduction by 2028 without a material slowdown in the economy. Now, if you told me Trump's cool with that and the administration's happy to kind of bring down growth first, have a slowdown, have an asset price correction that kind of, allows inflation to come down, allows the Fed really to cut rates materially, slows down global growth in such a way that the bond markets are rallying, then yeah, maybe. But this guy doesn't strike me as a guy that wants to see the growth slow down first. So I think
because it's not, you can't sell that as winning. People don't understand nominal versus real. They don't understand, their house might be worth a little bit less, but look, hamburgers at Five Guys don't cost $22 anymore. You can get them for $12 now. So you can buy more. You're wealthier. They just don't understand it. So I'm right there with you. I agree. I have a question for you. I wonder, what do you think? Because I had this wild idea, but I haven't really bounced it off any gigabrains like yourself yet. What if Trump said that they wanted to collect tariffs in Bitcoin? Because that will take away some of that dollar strength, maybe mute or mitigate some of that risk there in energy markets. And now you're creating that demand on Bitcoin, which you now have a strategic reserve, which pushes value back into the asset side of your balance sheet, right? Because I saw Trump on Rogan, and he was very smart about it. He said, it's not just about the $36 trillion in debt. And it's not just about, maybe I heard Howard Lutnick say maybe the asset side of the United States balance sheet is $400 or $500 trillion. But it's all illiquid, and it takes significant time and capital to unlock that liquidity. Not that you want to sell all of it anyway. So, it becomes growth, right? It becomes about the growth of the economy. And Trump said, if you spark growth in the economy, if I cut taxes and do some of the things that can create this growth, then we can get to a point where we're actually under levered instead of that sweet spot for being levered up with debt to maximize growth. But my thing is if you get this strategic reserve and the economy is huge. We're talking about multi-trillions. Bitcoin is just over a trillion. Real estate, like you mentioned, multi-hundred trillion. Bond market, multi-hundred trillion. Stocks, multi-trillions. So you have all these markets that are really just huge. And now you have this brand new digital emerging asset class, the reserve asset of the internet economy, I like to call it, and it's just over $1 trillion. So it would be easiest to drive value not into the growth of the economy or the stock market or the housing market, but into this brand new asset class, and that can help rebalance our balance sheet and get us to an under levered position where we have $36 trillion in debt. Yes, we have $219 trillion of unfunded liabilities, but we also now hold a significant amount of this asset called Bitcoin, which has a 50-60% CAGR. And even if that gets cut in half to 30% and that gets cut in half to 15%, we're going to be sitting pretty good. That's going to make up for some of maybe that growth that it can't be there because it's a zombie economy, right? Ever since 2008, it's like we're just shocking the cadaver. At some point in time, the zombies need to go away if you want to have true economic growth. So, looking for a balance between all of that and kind of just bouncing ideas around. What if Trump decided to collect tariffs and Bitcoin? Would that be, is that a potential solution? And then on top of that, that ties into the Bitcoin bonds I was telling you about, because if you collect in 2023, we collected $80 billion in tariffs. But if we each month we took that $6 billion roughly and then issued $30 billion Bitcoin bonds, we could raise an additional 24 billion each month. So we could raise upwards of $400 billion from the marketplace by creating a hybrid debt equity product, by incorporating and integrating Bitcoin into our treasury product. And I just wanted to bounce that off you.
Yeah.
I know you haven't had time to. I know you probably haven't seen or had time to think about it. But what do you think about that? What are your initial thoughts?
So look, I think there's the dynamics of collecting tariffs in Bitcoin is probably maybe it's a bridge too far for this government to do, or to kind of have the importers pay the tariff in Bitcoin when they don't have Bitcoin. I don't know. The dynamic there seems to be challenging, but you could potentially create an environment where you just kind of say, look, to this strategic reserve point, we're going to dedicate a portion of the tariff revenues earned to Bitcoin purchases, right? X% of any tariff that we receive every month, we're going to buy Bitcoin. So that could be part of something. What as you were talking, what I was thinking is that if you think about the wealth in this country, it sits in obviously the hands of very wealthy people, and doesn't circulate as regularly back into the economy. There's a lot of latent wealth in the real estate industry and real estate assets. There's a lot of latent wealth in the stock market that folks never sell. Insiders, they never sell, and they're able to borrow against it. And so the government has no ability to get that money. And so the government needs to figure out a way to get that money. Now, one of the proposals from the Harris administration, the Harris plan, was to tax unrealized gains, because the government realizes that they have a revenue issue and there's a lot of wealth out there and they have no ability to get it. So how can they go about getting it? And one way they conjured up is, well, let's just go tax unrealized gains, which seems absurd, and clearly was not something that was going to happen. And the Trump administration is not in favor of that. But the idea of trying to fund the government with the assets of this country, I can understand why they're thinking about doing it. But wouldn't it make more sense to try to have a mechanism in place that shifts the wealth from those latent assets like real estate, and maybe and stocks that never get sold, over to Bitcoin? Because then more citizens own Bitcoin, right? More people own Bitcoin. Bitcoin, the velocity of money from moving money out of the real estate market into Bitcoin as it's appreciating 40-50% a year, could be incredible. And so, and look, I think if we start to, you know, there are some people who think that Bitcoin gain shouldn't be taxed, but maybe for now they are taxed. So if if more wealth is moving out of real estate into Bitcoin as Bitcoin is appreciating, well, the government is going to be capturing incremental revenues as the Bitcoin market grows from taxes on realized capital gains. We already talked about, as the Bitcoin market grows, demand for stable coins is going to grow, which is going to grow demand for treasuries. So they have an added benefit of that. So yeah, look, I think the U.S. government generally will benefit from the Bitcoin market cap moving up materially over time. And yes, there's some people who believe that whales control Bitcoin, and so it's wealth inequality is still going to be as bad. But every citizen can buy Bitcoin very easily in any denomination. And if we're moving into an environment where the price of Bitcoin needs to kind of be mandated to move higher in order to solve some of these issues for the government, demand for treasuries, or kind of grabbing tax revenue out of an asset that has a higher velocity than real estate, I think that serves an incredible purpose. Now, thinking kind of further along, I suspect Bitcoin maximalists will say this is not the intent of Bitcoin, right? This is, we don't want this to be kind of, we don't want governments to be involved. We prefer, governments to move away. But I think that's kind of, we need to exist in the reality of the society and the world that we live in. I mean, the nation state is not going away very rapidly. And so this would be a way for the U.S. to, jump ahead again and renew its outperformance. And if we, because the rest of the East is certainly moving towards, or trying to move to, a gold standard, right? There's flows of gold moving from the West to the East. China's been buying gold. Russia has a ton of gold. Saudi's been moving into gold, right? So, in theory, the U.S. has 8,100 tons of gold. I hope we do. I don't know if we do. Some people would say we don't. But, do we think about skipping the gold move and kind of embracing more of a Bitcoin standard because the U.S. Maybe the U.S. created Bitcoin. Maybe that it really is a CIA NSA creation from way back. And so I don't know. I think there are benefits to introducing Bitcoin, in a more friendly, less regulatory onerous way into the economy that could serve multiple purposes, that can help reduce wealth inequality in this country, can give citizens access to a store of value vehicle that doesn't force them into consuming their wealth every day because they fear that inflation is just going to eat it away. And so I think there are benefits to that transition to a harder money society. And I think Bitcoin is going to be and should be part of that. And I like the fact that this administration is going to be more accepting of that, and all these suggestions and ideas are worth exploring, and hopefully we get into an environment where it becomes a bigger deal. And look, I think the price appreciation of Bitcoin over the course of the last couple of weeks, shows you that people are getting more excited about the prospects for this being part of the solution.
Yeah, absolutely. I mean, I never thought I would see the day when I first started that it would be so forefront and actually have the opportunity to make a real, true, and lasting economic impact. So it's wild to see. And for my listeners who maybe haven't heard yet, just kind of plugging myself here, Craig, sorry, but I have the honor of being nominated to the Maha MAGA movement on RFK's nominees for the People site for an economic advisory role.
Nice.
So it's really exciting that we're kind of getting past this kind of pay to play politics, and that the voice of we the people has a chance to be heard. So if you haven't already, please head over there and cast your vote for me if you think I would be able to give some good advice to those people, especially with a Bitcoin centric mindset, applying economics to the overall picture and maybe coming up with some ideas that some traditional economists would not have thought of, even if they're bad ideas. We still need to, like you said, innovate and try to figure out, how are we going to build this asset side of our balance sheet, whether it's through the economy itself, whether it's through unlocking some of our trapped assets and equity that we have in land and oil and gas, whatever it is, we need to find a way to do something because those liabilities are not slowing down and they're not going to slow down anytime soon.
And look, we can't just abandon the liabilities, right? I mean, people. I think maybe there's a view from some on the right about the welfare state and just too much spending on entitlements. It's like, look, these are commitments that have been made to people, whether it's through Social Security or healthcare. Like we don't want to have a population that continues to struggle, doesn't see a future. And look, with artificial intelligence and more displacement of jobs into the future, the state is going to be taking on a larger portion of the populace that struggles to find employment in an AI dominated world. So we're going to have to commit and fulfill these the social contract with the citizens of this country. Otherwise, we're going to run into Arab Spring type situations and revolt and revolution. So we don't want to go down that path. So the government does need to figure out how it's going to finance this growing welfare state. And so addressing that through the asset side of its balance sheet, I think is an interesting thing that should be explored, right? And so to the extent that the government is procuring and buying strategic minerals, is buying, is stimulating demand in domestic energy, is trying to reshore, and is owning Bitcoin. I think these are all fruitful and positive things that could eliminate the probability that the fourth turning that we're going through is going to be violent, right? I think that's ultimately what we are trying to avoid is a violent fourth turning. And so kind of acknowledging that there's a role for the state no matter what happens, and that we need to figure out kind of how to make it work. I think Trump and team have some interesting ideas. Not all of them are good, not all of them are bad. And I think there's some interesting ideas that come from the left as well, as far as how to take care of people, how to take care of workers. Should we, look, corporate profit margins in America are generally, for the big cap companies, are generally very close to all-time highs, right? I mean, there is room there to reallocate some of that wealth back to where, the rest of the people, right? And so we should be thinking along those terms. And I think Bitcoin, as part of the solution, kind of helps us along that path.
Absolutely. So I want to get into one last tweet here in our final segment about interest rates, what you said. This is the second rate cut of the cycle, but already the Fed is beginning to think about slowing the pace of cuts. And I thought that was interesting, hawkish development, as they are not in a hurry to find that neutral rate. And in another tweet, you were talking about the complete descent of the one member, and I believe it was I forget her name.
Yeah,
But yeah. And can you explain that dynamic and where you think you see interest rates going over the next couple of quarters?
Yeah. So Powell, largely gave a dovish press conference where he talked a fair bit about how inflation in his mind has been solved. But there was a question about if inflation, which is starting to tick back up again. We have a big inflation report tomorrow, CPI. I'm not sure when this will air, but CPI is Wednesday the 13th, and PPI is Thursday the 14th. So the combined of that gets you kind of the next core PCE reading, which will be known, and that comes out at the end of November. But the momentum on inflation seems to have already bottomed, and the risk of a reacceleration of inflation, I think, has grown. And so Powell, when asked about the interest rate, cycle, he made the comment that we have started the discussions about what would take to slow down the pace of rate cuts. And so you kind of go back to the tightening cycle, during COVID. I mean, he had made some comments like, we aren't even thinking about raising rates. Right? This is kind of, ridiculous Fed speak about forward guidance. And so the fact that now the Fed is thinking about slowing the pace of rate cuts is just a development worth thinking about. Sorry for the pun, but so if we get firmer than expected inflation data rest of this week, and then maybe again for the month of November that comes out in December, I feel like we're going to find ourselves in an environment where the Fed is going to be forced to take up their expectations for the interest rate environment in 2025. I mean, right now the Fed is looking for 4 interest rate cuts for 2025 after cutting again in December. So basically another 5 cuts. The market is expecting less than that, and so I think if we kind of see that inflationary print, it's going to force the Fed at the December meeting in their dot plot to raise their expectations for interest rates in 2025, as the economy is holding on better than they expected. Inflation is becoming harder for them to solve, and frankly, the labor market has proved to be a bit more sticky than they thought. They were really concerned in the summer, in July and August, about the job market deteriorating. Then we had a blockbuster September payroll print, and then still a reasonable print for the month of October, despite all the hurricane and strike data. So the evidence on the labor market drastically decelerating here just isn't there. And I suspect with the Trump and Republican sweep, we're going to see more momentum, more positive sentiment. You already saw it in some of the consumer confidence indicators are already starting to pick back up again. So, the likelihood that we're going to see a big fall off in employment between now and the end of the year just doesn't seem likely. So, if the Fed is taking up their expectations for inflation and for GDP and for the labor market for 2025, less cuts are coming. So we'll learn more about that at the December meeting when they update their dot plot. But I think we'll probably get another cut in December, and then from there, I think the Fed is going to be on skipped for January and wait and see. And then as we push through 25, if the tariffs are coming and if the tax cuts are coming and the economy is humming along, man, I mean, we could be in a situation for a longer pause at that point. Maybe the Fed doesn't cut in March, they don't cut in June, because the economy doesn't really warrant it. That's the prospect of that. I think the potential for that is growing.
Now, one last quick question, because I wonder, there was a lot of emotion around this recent election, and I think and it's well deserved, because we want to get back to public servants who empower we the people versus this kind of kleptocracy who can get into the piggy bank the most and who benefits the most from it. But when Trump got in 2016, and then Powell, we got the appointment, and then Powell ended up raising interest rates on Trump. So we had ZERP with Obama, with not a whisper of changing that. And then Trump gets in, and all of a sudden they start raising rates. Of course, that led to the 2019 repo crisis. Things come right back down. Now Trump gets in, and we just so happen to have sticky unemployment. We just so happen to have the economy looking pretty good, depending on what numbers you use. At Govflation, GDP has been negative for 10 consecutive quarters. So we're 2 quarters away from a textbook depression because of that demand destruction campaign. It worked the way that you would anticipate it to do. They didn't kill us. They slowed demand. They slowly constricted us. So that data matches the narrative more, I think. But even going with that mainstream narrative and data, how do you think the country would take to this? Do you think there would be more of a political anger than there would be in the past, because we're now seeing Trump get in again, and now it might be time to pause. Hey, it might even be time to go up again. Do you think there could be maybe some consequences that the Fed isn't anticipating that come from the political side?
So Powell was asked about the Trump agenda at this most recent press conference, and he definitively said that the Trump's election and Republican sweep has no bearing on how they're thinking about rates at the current juncture, because it's just too much of an unknown from an order of magnitude perspective, what the tariffs are going to look like, when are they going to be implemented, on who, and then with respect to the budget deficit increases, the tax cuts, when are they going to get passed, and then what is actually going to be the impact at what time. So Powell says we take policy kind of when it comes, and we know, and then we model what the potential impact is at the time. So I think there's runway here for the Fed to not be super hawkish with respect to this positive momentum that may be building in the underlying economy from a Republican sweep administration. But I would say that I think there is less tolerance by the American public for a resurgence of inflation. So to the extent that these policies or the markets started to lead to inflation coming back, oil prices higher, food prices higher, things that you could tangibly see kind of in real time. And look, I think in an environment where folks are excited, maybe that's a bad word, about the slowdown in immigration that's coming, or the supply of labor falling, wages moving higher is going to be inflationary. So are wages going to keep up with these price rises? Uncertain. So if we find ourselves, and there's been plenty of charts that have been thrown around about how the current cycle may look like the 70s inflation cycle, we could be entering this second wave. And if you kind of put the charts up on top of each other, the inflation bottom is now. Or within the last 2 months from 2 months prior to 2 months forward, maybe we've already hit the inflation bottom, and that would mean we're looking at a fairly rapid appreciation of inflation momentum come the second quarter of next year. I don't think that the American public is going to be very tolerant of that very quickly. And so now, is the Fed going to be forced then to tighten policy further in order to slow that down? Probably. So I think but I think it'd be justifiably so if the public is looking at 3.5%, 4%, 4.5%, 5% inflation again for the back half of 2025. The Fed will have to really get religion on raising rates again, I think. Now,
and then that interest expense goes up, which increases the deficit.
This is the problem, right? The Fed has painted itself into a corner here in a variety of ways. They've been so reluctant to move aggressively on their balance sheet and kind of reduce excess liquidity from the system. They should have engaged in proper quantitative tightening instead of just rolling off securities. They should have been selling securities when they could. They decided not to. And so now we're in this kind of ridiculous box where the only tool is the rate tool. Higher rates means the U.S. government can't really fund itself. Higher rates means the lower half of the K-shaped economy of people who don't own assets, don't own homes, have credit card debt, get pushed further and further into disarray, and the wealthiest people keep doing fine. And so that's a shitty outcome. Sorry for the swear, but that's ultimately what the Fed could do. And if they cut rates, which they tried to do here, look what happened in this environment was because they didn't solve inflation. The bond market sold off anyway, and so mortgage rates went up. The cost of borrowing for the government really hasn't fallen much. Bitcoin has kind of went to the moon. Stocks have went to the moon. So the wealth effect has continued to move higher. And we're running the risk that we may have an asset inflation issue again. So they're kind of, have forced themselves into this kind of damned if they do, damned if they don't environment. The only real solution is to in my view, is to kind of allow the bond market vigilantes to come out, sell off bonds, see the long end rise, term premiums expand, equity multiples get hit, liquidity comes out. We have a proper asset price correction that takes some of the boil off of inflation for real, and allows the economy to reset, allows the Fed then to bring down interest expense, and maybe then with some kind of macro prudential fiscal policy of forcing industry and spending into areas of the economy that we need it, in housing and domestic infrastructure, and start to incentivize those areas. That's how you would energy and domestic energy production. Then we could build a proper recovery and a proper economy. But it does unfortunately, necessitate an asset correction. And just it's hard to it's hard to bet on it, and it's hard to see that the Fed is going to be tolerant of it when around every turn they prevent it. Whether it was the repo crisis, whether it was even during COVID, whether it was in the fall of 2022, the gilt crisis that we had, the Liz Truss moment in the UK, they came in with liquidity. The fall of last year, the SVB crisis, right? There's been 5 or 6 instances where Treasury market dysfunction from a dollar strength and yields moving higher has forced the Fed, or has led to the Fed and or Treasury adding liquidity sooner than they should, which has only made the structural issues in the economy that much worse. So
I mean, the bank term funding program, right? I mean, you're in the middle of tightening. You're in the middle of quantitative tightening. You're raising rates, and then you have to create inflation. You have to make up the difference between the mark-to-market value and the par value of all those securities being borrowed against. And that's the kind of wall they're being backed into. And like you said, unlike Bitcoin, where we see a destructive part of the cycle, Bitcoin goes all the way up, it comes down, and it destroys companies, it destroys people, it destroys mismanagement. And then people wonder how it can grow so volatile and grow so fast after that. Because after that destruction takes place, you start from a stronger foundation. And the economy would experience a similar thing if we were able to get rid of these zombies and kind of wash this out and regrow, not from an inflated platform, but from the base layer of where there's true value in the economy and true velocity going back and forth. Craig, thank you so much for joining me here today. It was a deep dive, and I know my community is going to love this conversation. So I really appreciate you taking the time. Everybody, you guys got to follow Craig on Twitter and check out the Bear Traps report. It's a no-brainer. They're also shooting their Discord channel off pretty soon, so keep an eye out for that. I know a lot of you guys like Discord. Craig, I'll give you the final word to the audience. Thanks again so much.
Yeah, no, thanks for having me. It's a great opportunity to just kind of share this long form, kind of how I think about the world and investing. And look, not all of these things are investable on a everyday basis, but I think kind of understanding where the world is likely to be in 6 to 12 to 18 months is a useful tool. And so what we're trying to do is kind of aggregate these important conversations that investors are having around the world, and aggregate that information, synthesize it, and kind of disseminate it back out in a digestible format. So come check me out on Twitter. My handle is CES921, and our website is thebeartrapsreport.com. So again, thanks very much. Really appreciate it. Great opportunity to chat with you.
Thank you. I look forward to doing it again.
Awesome.
Take care.
Thanks.